think about this. I mean, today futures are down, and we've seen valuations move down more than 20%. There's a lot of bargains out there, and the way that consumers are out there right now in line shopping, I think that investors have to get in line too and say, these are great deals. These are great companies. These are earnings that maybe not be growing at 25% year over year next year, but we're still looking at 8 to 10% earnings growth. And that's nothing really to shy away from. Sure, there's a lot of change out there. There is with the Fed repricing money. There's the trade tariff issues and the ongoing issues with China. But the economy is doing well, Main Street is doing well, consumers are out there shopping, and companies are making money. So even though I think investors there's so much uncertainty out there, there really are some good bargains. So I think that investors should be out there, and I think that we will see investors have a moment of clarity, and we will see somewhat of a Santa Claus rally.
Everybody mentions the valuations looking a lot better, but that's on the assumption that the earnings growth rate for next year will remain the same. I mean, do you think that we have priced in the potential impacts of the 10% tariffs going to 25%, of maybe the second round of tariffs going into effect, and the lapping of the tax cuts? I mean, I'm just wondering how solid those earnings growth estimates are, because if they are not and they are going to be moved down eventually, then maybe valuations don't look as good as they seem to look.
Well, that's a good point, but there is going to be some margin compression as we do see some cost pressure. But remember, the stronger dollar has buffered some of the tariff impact. And I don't think that we're pricing in the fact that China is stimulating their economy. And there's a lag on that. And we saw some soft numbers in Japan and Germany in the third quarter. I think we're going to see some stronger numbers as some of that stimulus in China works through the system. And then we're going to see some better growth numbers in the fourth quarter overall worldwide. And that's going to work through to the U.S. economy, too. Sure, things have slowed down a little bit, but they're still going very well. And I think that 8 to 10% earnings growth for 2019 is realistic, even with all of the uncertainty out there.
The flip side, though, Karyn, and I'm going to ask Yuri this question, the flip side of the stimulus in China helping us, et cetera, is that a global synchronized slowdown could hurt us. So, Yuri, where do you stand on that? Because, for instance, we got German PMIs, and they're the lowest in 4 years.
So global growth has clearly slowed. And even in the U.S., when you look at it on a rate of change basis, you look at the ISM index, it's clear that the rate of change has peaked, but the level is still growing. You know, we don't see any sign of a recession on the horizon at all. But China is slow. And actually, one of the big opportunities, or one of the big things that we're looking at is, EM versus the U.S. Yeah. The gap is 20 percentage points. So I think the U.S. will slow, and you're seeing it in the earnings numbers. The calendar 2019 earnings estimate is progressing exactly the way they tend to. They start too high. Right. They end up at around 5 to 7%, and we're at 10% and falling. So that's one of the reasons I think the market sold off, is because it's grappling with that and with the notion of the Fed going to neutral. But, I have a question for Karyn. There's this big dichotomy where the bond market is kind of chill. We're 10 years at around 310, 320. You haven't seen that drop in yields that you normally see when the S&P trades down 11%. And so one of the questions we're all asking is, who's right? Is the bond market right and things are okay and it's technical selling in the stock market in the momentum trade, or is the stock market right and the bond market just isn't paying attention?
I would say in this case, I think the bond market is right. The bond market is pricing in inflation, which is tempered somewhat, and we don't see inflation being a problem, and growth. And growth is moving through, and we do see growth. But there's not that inflation there. So I think that the bond market has it right. The yields are moving up. We're now above 3%. They're not moving up too much because we've already priced in growth, and we see a little bit of a pullback in inflation. So I'd have to say I think the bond market is right. And I think recently the equity investors have been a little bit too cautious, just because I think especially the whole situation with China, it's really hard to get your arms around the extent of the whole trade negotiations. So I think that's probably it. Plus then the Fed just continuing to raise interest rates, as you said, Yuri, and we don't see that inflation. So those two things are just such uncertainties that I think that the equity market has been a little bit too cautious.
Give me a percent, Karyn. What kind of Santa Claus rally are we looking at? Is it 5%? 2%,
I'm thinking 5%.
3%?
I think
From
5%
here.
could be very easy. 5% in December could definitely happen because I think we're a little bit too low.